Hi, welcome back to the channel. In today's episode, I want to provide you with an update on the growing economic damage now being caused to the global economy by the war in Iran. And this situation is becoming increasingly serious. Donald Trump is now threatening renewed military strikes against Iran within the next few days if no deal is agreed. Oil prices have been above $90 per barrel for more than 70 consecutive days. Inflation is now starting to surge around the world as energy shocks feed directly into the cost of living. Bond yields in the United States have surged to their highest levels since 2007, just before the global financial crisis, flashing major warning signs for the global financial system. And now stock markets are starting to acknowledge that this situation is becoming a genuine economic problem. Over the last few days, we've seen increased volatility and weakness in global equity markets as investors begin pricing in the impact of higher energy costs, rising inflation, weaker consumer spending, and lower corporate profits. There have also been reports of drone attacks near nuclear infrastructure in the Gulf region. The Strait of Hormuz remains effectively closed. Major companies are warning about rising costs, and governments are intervening to shield consumers from soaring energy prices. And the longer that this goes on, the more dangerous this becomes for the global economy, because this is not a short-term crisis. This is now becoming embedded into the global system. But before we get into the details of everything today, could I ask anyone that hasn't subscribed yet to please hit that red subscriber button? Really helps me with the algorithm and puts a smile on my face. Now, one of the big questions here is this: why does it matter that the price of oil has been above $90 per barrel for 72 consecutive days? Why is that such a big deal? Well, the easiest way to think about this is to compare it to your own personal finances. At the start of 2026, oil prices were sitting at around $60 per barrel. So imagine your own personal spending budget, your limit, was $60 per day. And then suddenly one day you spent $100 instead. Well, that would be painful, but manageable for one day. Then the next day you spent another $100, and then again the next day, and then every single day for more than 10 straight weeks. Eventually, your finances would start to break down. You'd have to start cutting back. You'd struggle to pay your bills. Your debt would rise. Your stress would rise. And eventually, something would have to give. And that's essentially what's happening right now to the global economy. The entire global economy was built around much lower energy prices. At the start of 2026, oil was at $60 per barrel. Factories, airlines, shipping companies, logistics firms, food producers, chemical plants, transport networks, governments and consumers were all operating based on those costs. And now, for more than 70 consecutive days, the world economy has been forced to operate with oil prices massively above those levels. And the really important point here is this: this is not happening because the global economy is booming. This is not being driven by a sudden surge in economic growth or demand. This is not a situation where GDP is soaring and consumers are all suddenly spending huge amounts of money. This is an energy shock. Prices have jumped because supply has been disrupted. The Strait of Hormuz has effectively been closed. Shipping routes have been disrupted. Insurance costs have surged. Energy markets have become unstable. And the result is that the global economy is now paying dramatically more for energy without getting any additional economic benefit in return. That is the problem, because higher oil prices caused by strong economic growth can sometimes be manageable. Businesses are making more money, consumers are earning more, demand is stronger, but this is completely different. This is effectively a giant extra cost being imposed on the entire global economy. It's like suddenly increasing the operating cost of almost every single business on the planet at the same time. And eventually, someone has to absorb those costs. Either companies absorb them and their profits fall, or consumers absorb them through higher prices, or governments absorb them through subsidies and support packages. But ultimately, the damage still exists somewhere in the system. And after more than 70 straight days of elevated prices, the consequences are now starting to emerge everywhere. We're seeing it in inflation data, we're seeing it in the bond markets, we're seeing it in company earnings, we're seeing it in fuel prices, and we're now increasingly seeing it in stock markets. because investors are starting to realize that if oil prices remain elevated for months rather than weeks, then corporate earnings forecasts may simply be too optimistic. Higher transport costs reduce margins, higher manufacturing costs reduce profits, higher fuel costs reduce consumer spending power, higher inflation keeps interest rates elevated, and all of that ultimately feeds directly into company revenues and earnings. So the market is now starting to reassess the risks. And I think there's a very real possibility that if this situation continues, we could see significantly more weakness in global stock markets over the next few weeks, and the real economic damage starts feeding through into quarterly earnings and company guidance. Now, the first major development today is political. Donald Trump has once again threatened Iran with what he's calling a big hit if there is no deal agreed soon. And that's incredibly important because although there has been a ceasefire, the situation is clearly not resolved. The Strait of Hormuz is still closed, oil is still trading at extreme levels, shipping is still being disrupted, companies are still warning about costs, and now we have the US president openly saying that military action could resume within days if there's no agreement. So the world is not looking at a clear end to this crisis, it's looking at a stalemate. And economically, a stalemate can be just as damaging as war itself because businesses can't plan ahead, governments can't forecast, central banks can't cut interest rates with confidence, and consumers are left paying the bill. The second major development I want to talk about today is inflation. We're now starting to see oil shock appearing in official inflation data from all around the world. South Africa has just reported inflation of 4% for April, which is up from 3.1% in March. Now that is a very sharp jump in 1 month. The Eurozone has also seen inflationary pressure increase significantly over recent months as energy prices have surged. The United States is seeing inflationary pressure increase, particularly in fuel and transport costs. So the pattern is becoming very clear. Countries that rely heavily on imported fuel are now starting to see the Iran war turn into an inflation problem. And this is exactly the risk we've been talking about. Oil prices don't just affect petrol and gasoline stations, they affect transport, they affect shipping, they affect food, they affect airlines, they affect manufacturing, they affect packaging, they affect chemicals, they affect plastics, they affect basically everything that has to be moved, heated, cooled, produced, or delivered. So when oil stays above $100 for a few days, that's painful. When it stays there for weeks or months, that is dangerous. And it stayed there for over 70 days, that is now becoming a systemic economic problem. Now the UK I want to talk about because it's a very interesting case. On the surface, it looks like the UK has bucked the trend. UK inflation in April actually dropped. And at first glance, that looks like good news. But when you look underneath the surface, it's a much more complicated picture. The reason UK inflation fell in April is not because the energy shock has disappeared, it hasn't impacted on it. It's because household energy bills have been protected by the UK government intervening with an energy price cap. In other words, consumers are being shielded from the full impact. But that doesn't mean that the cost has vanished. It means the cost has been moved. Instead of households paying all of it directly through increased bills, the government is absorbing part of the pressure. But somebody still has to pay for that. And ultimately, it will be UK taxpayers. So the UK inflation number is being distorted. It looks better than the underlying reality because if you look at petrol prices in the UK, the picture is completely different. Fuel prices have surged sharply as a result of the shock. Producer price inflation has also jumped because companies are paying more for crude oil and energy. So the UK is not immune, it's just that the pain is being delayed, disguised, or transferred into public finances. And that brings us to the bond markets, because this might actually be the most important part of today's video. US 30-year bond yields have hit their highest level since 2007. And just to remind you, 2007 was just before the global financial crisis. Now this is a major warning sign. When long-term bond yields rise like this, markets are effectively saying they are worried about inflation, government debt, and the future cost of borrowing. And for the United States, that's a huge problem because the US already has an enormous debt burden. Interest payments are one of the biggest expenses for the US government, and if yields keep rising, the cost of servicing that debt rises as well. That creates a vicious circle. The government has to spend more money on interest. That leaves less money for everything else. Then investors worry about the debt, so they demand higher yields. Then the cost of debt rises again, and around it goes. This is why bond markets matter. They're not just boring financial charts. They are the price of government borrowing, and right now they're flashing a warning signal. Then there's the security risk. One of the most worrying stories of the last few days has been the drone strike near the Barakah nuclear power plant in the United Arab Emirates. The reports suggest that the drones may have originated, interestingly, from Iraqi territory, potentially linked to pro-Iranian militia groups. The key point is that this attack did not cause a nuclear disaster. Radiation levels remain normal, but it did damage infrastructure linked to the site and raised a much bigger question. If nuclear sites, energy infrastructure, shipping lanes, oil terminals, refineries and ports are all now vulnerable, then the risk premium in global energy markets is not going away quickly. That's the danger. Even if there's no new major attack, the threat of one keeps prices elevated. And if Donald Trump does start the bombing campaign again, or if Iran retaliates through proxies, then markets could panic. So where does this leave the global economy? Well, it leaves us in a very difficult position. Oil has now been above $90 for the last 72 days. Brent crude remains above $110 a barrel. Inflation is rising in multiple countries. Bond yields are rising. Stock markets are becoming increasingly volatile. Companies are warning about higher costs. Governments are intervening to shield consumers. And the geopolitical situation remains extremely unstable. That's the real story. The war may not dominate the headlines every day anymore, but the economic damage is still spreading throughout the global system. And the longer this goes on, the more embedded the damage becomes. Higher fuel prices become higher transport costs. Higher transport costs become higher food prices. Higher energy costs become higher production costs. Higher inflation becomes higher bond yields. Higher bond yields becomes higher government debt costs. And weaker consumer spending eventually becomes weaker company profits and weaker stock markets. And that's how one conflict in the Middle East turns into a global economic crisis. So I'll keep you posted on any further news and developments, but hopefully you found today's video useful, informative, and most importantly, thought-provoking. If you've liked what I've said, or maybe you didn't like it, but you thought it was interesting, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already.